comes down to computers communicating.
The information superhighway can be a confusing mix of on-ramps and off-ramps.
Bitcoin is worthless artificial gold.
Is it still rat poison?
Probably rat poison squared.
We need to get into the world of, okay, this is actually foundational technology.
What the Internet of Money does is it creates a single network which can do a microtransaction to a gigatransaction.
The Internet is going to be one of the major forces for reducing the role of government. The one thing that's missing, but that will soon be developed, is a reliable e-cash.
All right. Welcome back to another episode of Final Settlement. Super special episode today. Very excited for this one. Been looking forward to it all week. And we have Pierre Rochard on the show. And so I'm sure many of our audience members will know who Pierre is and know of his work. But in case you're unfamiliar, Pierre has been at the forefront of Bitcoin advocacy and really education for over a decade as a very early adopter of Bitcoin, a prolific writer, a co-founder of the Satoshi Nakamoto Institute. He's really played a critical role in sort of shaping the intellectual foundation of Bitcoin in general over the past, over a decade. And so, he's also helped sort of drive institutional adoption and education through, his work in the corporate world, most recently at Riot Platforms. And so we're really excited to dig into, his journey, his views on Bitcoin's future, and in particular, the Bitcoin bond company, which was announced recently that Pierre will be launching soon. And so very excited to dig into all of that and maybe a few other topics, because there's no shortage of things happening in the Bitcoin space right now. It feels a little overwhelming at times, the amount of the deluge of news on a daily basis. But Pierre, welcome to the show. Thanks for joining us.
Thanks, Ryan. Thanks, Liam, for having me on.
Yeah, well, let's get into it. I think a logical place to start is sort of what preceded your vision for the Bitcoin bond company, which I think is something that's been rattling around in your brain for over a decade. And so you wrote a piece back in 2014 called Speculative Attack. And so maybe, just for the audience, if you could give a brief overview of what your thesis around sort of speculative attacking the dollar with Bitcoin was at that time, and then sort of maybe talk about how that's evolved over time over the past decade from when you first had these ideas into, where we sit today, everything that's going on from corporate adoption to sovereign level adoption. And, one, I guess, have things gone according to how you thought they would? And then beyond that, how did that influence how you're thinking about things going forward?
Yeah, absolutely. So I think that the place to start would be back in 2005, I was a high schooler, and I stumbled into Austrian economics and sound money. And what I really liked about that was that they had an explanation for the business cycle that actually made sense to me versus some of the alternative explanations that I heard in school. And that drove me to really being silver and gold type, focused, intellectually, right? But at the same time, I was really interested in free and open source software. So I was installing Linux on computers and listening to Richard Stallman lectures on the philosophy of users controlling their own code. And I didn't think that those two paths would really cross until my last year of grad school. I was getting my master's in financial accounting here at UT Austin, and got introduced to Bitcoin as sound money, that there would only ever be 21 million, and that it was open source. And so this monetary policy had credibility to it. So really went down the rabbit hole at that point and started writing about Bitcoin. From my perspective, which was very focused on monetary economics, and wrote a series of articles leading up to Speculative Attack, where on Speculative Attack, I really wanted to dig into what's the end game for Bitcoin, and how does it ultimately prevail in currency competition. And so in the world of monetary economics, there's a concept of a speculative attack. The term was coined by Paul Krugman, of all people, and he was looking at it from an academic perspective of what had occurred in the Asian currency crises that were in the 90s. And the broad strokes of it is that you have investors who are borrowing in a weak currency in order to sell that weak currency and buy a strong currency, have the strong currency appreciate in value, and then sell the strong currency to pay off the loan that was denominated in the weak currency. And that this has the effect of, first of all, creating more weak currency, because when you're doing a loan through the commercial banking system and a fractional reserve fiat system, they do create more currency, and that it's a cycle where the weak currency can either be defended by raising interest rates, so that just makes it more expensive to borrow it, and so then the carry trade falls apart, or through capital controls, where the monetary authority will find ways to clamp down on the speculators and to prevent them from borrowing the weak currency, or by defending it using currency reserves. And so having the strong currency in reserve that they can use to stabilize the exchange rate and to make the trade unprofitable for the speculators. So with that framework in mind, I looked at it through that lens of, well, what would it look like if people were borrowing in this context? The strong currency is Bitcoin, so they're borrowing the weak currency, which might be dollars, it might be Swiss francs, which is generally thought of as a strong currency, but not as strong as Bitcoin, or Indian rupees, or Turkish lira. It could really be any currency that they're funding the trade with. And that would be the end game for Bitcoin, in the sense that it would wreak havoc on the currency markets and cause all of these weaker currencies to hyperinflate and to disappear if they were not defended. Now, what we've seen over the past 12 years since I wrote that is that indeed there has been that dynamic, and that ultimately the limiting factor for it has been the one limiting factor that I did not write about, that I didn't even think about, was the fact that so many people would make so much money off of the strong currency, off of Bitcoin appreciating, that they actually want to rebalance their portfolios, even if they're not involved in the speculative attack at all, right? So they want to rotate into, unfortunately, sometimes altcoins, right? And they want to ride some kind of altcoin wave, or they're just buying stocks and bonds, or paying off their mortgage, or putting their kids through college, or just taking chips off the table after a 10x or 100x. And so we've seen lots of people, they end up regretting making that decision, because then Bitcoin recovers eventually. But that's what drives a lot of the selling at the top of the cycle. But we also have seen after the COVID inflation, US dollar monetary policy tightened. And so we saw rate hiking from 0% to 5%. And we also saw capital controls. So this was what we described as Operation Choke Point 2.0, where the banking system and the wider financial system, because we could include the SEC not approving the Bitcoin ETF in this kind of capital control, where they're trying to gate investor access to the strong currency in order to defend the weak currency. Although maybe they consciously didn't think of it that way, that was the effect of that. And also, that they were able to seize Bitcoin through, the criminal justice system and develop a currency reserve of the strong currency. And we also saw them, selling off Bitcoin, which had the effect of suppressing the Bitcoin price. So that was now all of this is, in flux now with this new administration. So we're looking at lowering interest rates, removing capital controls, and building up a reserve instead of selling one off. So I think that Bitcoin's going from headwinds in that regards to tailwinds, and so I think that in many ways the speculative attack is going to continue unabated. But I think that my thesis was really that it would cause the dollar to collapse. But I now I wonder if that's actually not the case, in the sense that if we're building up a reserve of Bitcoin, that the dollar ultimately could just be backstopped by Bitcoin, and that it becomes a proxy for Bitcoin. Maybe one day we'll have like $1 equals one Satoshi equilibrium, and it's all 100% reserve, and the dollar is just an overlay on top of the larger Bitcoin monetary system. In terms of like what I got wrong with the speculative attack, I think was really something that should have been obvious at the time, but I didn't really think through this part of, well, what are the speculators borrowing against? So I had it in mind that they were borrowing against traditional financial assets, whether it's treasuries or mortgages, real estate, and the like. But it didn't cross my mind that they would actually be using Bitcoin itself as a collateral, which, what better collateral could you ask for than the hard currency itself? And so that was probably the biggest missing piece of in speculative attack. And also, what are they financing? What are the financing mechanisms specifically? I limited my observations and my thinking to the commercial banking system. And so there, they would only really accept traditional forms of collateral in the commercial banking system. Saylor opened my eyes to the fact that you could actually use the equity markets to be the financing mechanism, outside of the commercial banking system. So that's, at the same time that I was writing Speculative Attack, I was working in the traditional financial system. So I was working at Deloitte, auditing mortgage-backed securities and other kinds of new issuances of securitization transactions. And even back then, I thought, even though I didn't write about it in Speculative Attack, I did have an Excel spreadsheet open of what would it look like to securitize Bitcoin and to put Bitcoin as collateral and to issue bonds against it. It was way too early, one, on the regulatory part, where the SEC was not even approving the Winklevi Twins ETF back then, but also just in terms of the maturity of the market, that there was not a broad acceptance of Bitcoin as a store of value, as a digital gold that really emerged over the subsequent 12 years. So now is the right time, though. So that's why I decided to found the Bitcoin Bond Company and to pursue this dream I've had of issuing bonds to finance Bitcoin.
Yeah, that's very well said. And many of the people that have been selling their Bitcoins after their 110x gains definitely have not read the Satoshi Nakamoto Institute about hoarding Bitcoins too, which was definitely prior to the speculative attack and that whole line of research too. But yeah, on that point, I guess like over time, you talked through a bunch of different ways to borrow against Bitcoin. I guess, can you speak to what you perceive as the trade-offs between personal and localized speculative attacks versus the corporate and pooled speculative attacks, both in terms of access to liquidity and what the end benefit can be to the user?
And also, just to add to that, sort of like the how these ideas and concepts have evolved, because like I remember I first started learning about Bitcoin in sort of 2017, 18. I didn't have a lot of money. I didn't have a massive salary, but I was personally speculative attacking the dollar by just taking on credit card debt and buying Bitcoin with my entire salary effectively. And so we've gone from that, like individuals taking it upon themselves to do this, to now corporates and nation states thinking about these strategies.
Yeah, so I think that individual like retail buying of Bitcoin and leveraging up, in various ways at the individual level is going to continue. I would caution folks that that does come with risks, right? That you're on credit cards, you're paying a higher rate of interest um, than than you can access at the institutional level of there's essentially an economies of scale part where they have a lower cost of financing. But also there's a structural part that there's the difference between personal credit risk and corporate risk. And so when on the lender side, when they're underwriting these bonds or loans, that it just comes with different risks, right? So and also, at the individual level, we've seen products like margin trading at exchanges, where there you have a risk of getting liquidated if Bitcoin flash crashes. And so I think that at the individual level, it can really be challenging because of the different economics than, for example, Saylor can have with a convertible bond, where it's just a completely different ballgame. And so in some ways, I think it'll continue at the individual level. I would encourage people to do it in a responsible way where they're just focused on spending less than they earn, so that they can plow their free cash flow into Bitcoin. And that's you got to stay humble and stack sats. And then at the corporate and institutional level, I think that's where, because it's a limited liability company, and that they have, I would argue, perhaps more expertise in leveraging up and access to different products that might be a little bit safer to leverage up, that they're going to be at the forefront, the tip of the spear of the speculative attack, and that the financial engineering does take a lot of nuance at that scale.
100%. And there's also legal and controls that are in place that can help get lenders more comfortable with lending to large corporates rather than individuals like myself. If I just went to a bank and tried to ask for a big loan to buy a ton of Bitcoin.
But Liam, that might be changing now that the Fed recently, just today or yesterday, announced that they're going to allow commercial banks to work with Bitcoin. So it might not be long before we can just deposit Bitcoin at JP Morgan and take out a mortgage against it, essentially. Because from the risk perspective, I think that the biggest risk is essentially term risk, right? That Bitcoin's very cyclical. So if you're taking out a loan that's a 1-year term, then you could be underwater after 1 year and you can't refinance it, and then you're in trouble. If you get out to 5-10 years, now you're really going through the cycle, and that as long as there's no liquidation clause in that now it's, I think, a much more constructive relationship between the lender and the borrower, and maybe less extractive.
100%. Yeah. There's something to be said about just keeping dollars in your checking account and Bitcoin in your savings account with banks moving forward as well.
Yeah.
One other question is, like, in the past you discussed roughly like MicroStrategy imitators as being not too far behind. Semler and Metaplanet were early on, and 21 Capital this week. On a long enough time horizon, you said we should expect the share of the equity market participants adopting a similar strategy to trend to 100%. I guess, like, why do you think this is the case, and how do you see different Bitcoin corporate security vehicles kind of changing over time? And I guess, like, on top of that too, anything you could share about the MNAV and how long this arbitrage can take place would be helpful.
Yeah, so when Saylor first announced his first $500 million buy, I was working at Kraken, and I remember we had a webinar, and one of the questions was like, what's your craziest prediction for the year? Which mine was that half the S&P 500 would imitate Saylor and go all in on Bitcoin. That did not pan out, and so add that to the long list of overly bullish predictions that Pierre Rochard has made. But the principle, I think, still stands that on a long enough time frame, that will be true. And it's true because these companies are either going to be decapitalizing themselves and not have access to capital anymore, because all the capital is going towards Bitcoin companies. And so I think that they would end up either getting acquired by a Bitcoin-backed company, or you've got an activist shareholder telling them to put Bitcoin on the balance sheet. And that the second part of the question I forget now.
I guess, how long do you think that the arbitrage can take place? And do you think this is something that can, do you see like MNAV kind of trending towards one? Or what's your view there?
So this is something, I learned about securitization before I learned about Bitcoin. And one of the most counterintuitive things about that world is that when you, let's say you're just repackaging a set of mortgages, you would think that the total value of the securities on the liabilities and equities side of the balance sheet would equal the total value of the assets on the collateral side of the balance sheet. And to my surprise, that was not the case. You do end up with a premium to the NAV. And the reason for that premium is because, contrary to what a lot of Bitcoiners think, but also just I think the average layperson assumes, financial engineering does create value. And so by tranching up the risk return of the asset, you're able to grow the pie of people who want exposure to the asset. And so that's really where the MNAV multiple comes from. And then there's a speculative element when you're talking about it in the terms of, a liquid equities, where you have to think about how will Saylor or anybody else be able to manage the capital structure in the future to further drive value to the equity tranche by taking on debt and by leveraging up. And so to me, the MNAV is the combination of today's leverage with tomorrow's possible leverage, because we're discounting future cash flows. And so that's where I think it comes from. When does it go away? Well, I would argue when we've succeeded. So when the dollar is at Sats parity, and that we've reached an equilibrium between the Bitcoin and the dollar. If U.S. dollar policymakers are prudent and have a path to that equilibrium. If they are not, then I fear that the dollar will trend towards zero, and the MNAV in dollar terms will continue to exist.
So maybe sort of an extension of what we're talking about. What I'm curious to get your thoughts on is, from the perspective of any sort of company or entity, it's completely rational to adopt this strategy, right? Hoard the good money and effectively short the bad money. And what we've seen over the past 12 to 24 months is increased sort of perpetual new adoption of this strategy. And I guess in my mind, I struggle to think about, is there a point of saturation effectively where we don't need all of these different tickers that are Bitcoin treasury strategies? Obviously, again, from the company perspective, totally rational thing for them to do. But from like the prospective shareholders' perspective, in your mind, does most of this flow towards the largest player, i.e. strategy? And then like beyond that, there's obviously advantages to specific jurisdictions, right? So like if you think about a Metaplanet, they're the only one there. So that's why I think they have an advantage in that respect. But maybe if we're just thinking about the United States, like if we wake up in 5 years and there's 100 different companies doing this strategy, does that impact what MNAV looks like for the long tail of these companies? Because most people will just go to the largest one that has the most flexibility and optionality to tap capital markets to do these things.
Yeah, so I think I agree that if other entrepreneurial publicly traded companies don't find ways to differentiate themselves from Strategy's approach and the capital structure that Saylor is developing with Strike, Strife, and the converts, and we'll see what else comes out of their quarterly call that's coming up. I think that if they don't find ways to differentiate themselves, then it is challenging because of the liquidity network effects, right? Where now we have even a layer on top of MicroStrategy of the yield farming, if we want to call it that, the volatility harvesting with MSTY and IMST, where you do need to have a liquid options chain to be engaging in those activities, and so it becomes a flywheel effect that becomes really hard to challenge. On top of the fact that how do you acquire 500,000 Bitcoin? He's very far ahead of like number 2 or number 3 or number 4. So that said, there are lots of other very smart people in the world who could find a differentiating angle and maybe could have ways of approaching this that, for example, for myself, when I think about it, from my securitization background in the debt side, that's where the way I think of differentiating with the Bitcoin bond company is by just doing all debt and no equity, and essentially redistributing the equity to the bondholders, which is something that a publicly traded company just can't do, just because of the path dependency that they're on. They're on the they need to accrue value to the shareholders of the common stock, and that's the fiduciary mandate. And so, in terms of accessing different pools of capital, I think that there are differentiated strategies that are possible. Some of them we could think of today. Others will be caught by surprise, tomorrow. Of like, wow, why didn't anyone think of that sooner? And I think that that was the experience with MicroStrategy of, hey, why didn't anyone think of doing this sooner? Because there were publicly traded vehicles before Strategy, tackled this. So there's also, maybe, and I personally, I like the approach of just keep the Bitcoin in cold storage. Don't try to get fancy on the collateral side. Maybe some will take more risk and try to generate yield off their Bitcoin, or offer, kind of different approaches on the collateral side. Even, we've heard of people trying to do this with Solana. Obviously, as a Bitcoin maximalist, I think that, they're building on sand, and that's really going to underperform Strategy. But from a narrative and marketing perspective, maybe they attract a different set of investors. That I hope that answers the question.
Yeah, no, that's all super helpful context and thinking around it. Maybe we can sort of pivot and jump into more about the Bitcoin bond company. So maybe just sort of high level, how you're thinking about it, what types of credit instruments you're planning to offer, and how you're thinking about distributing them, various sort of cohorts of investors that you think are going to be interested in this. And we can just start high level, and then we'll dig into some details.
Yeah, absolutely. So I think that what I'm interested in is shifting the Overton window, and that's I always try to find kind of what's the hardest thing to work on, right, in Bitcoin, and I enjoyed doing that a lot with Bitcoin mining and the environmental impact, with Elizabeth Warren and her goons, as I think President Trump put it. So on the capital market side, I think that the hardest shift is in the bond market, because that is where the most conservative investors are. And so Saylor's taking a crack at it with the converts, and I think that makes a lot of sense. It's still, when we think about the convertible bond market, that's a subset of the overall bond market that the natural buyers of that might be arbitrage traders who, at the end of the day, are very active in the equity markets, and so it's as adjacent to the equity as one can get in from a bond perspective. And so I'm really interested in going deeper in the capital stack of finding ways to open up the Bitcoin conversation with institutional investors who might balk at the volatility of spot Bitcoin, and also not have a mandate to invest in a commodity, right? From a regulatory perspective, that's what it's categorized as, for better or for worse. Even if it were categorized as a currency, they still wouldn't have a mandate to hold a currency. And they're focused on credit instruments. So first of all, providing a wrapper around Bitcoin that is credit focused, and doing it in a way that is also institutional grade, meaning that it's inside of a bankruptcy remote SPV. There's no counterparty risk, corporate risk. The way the traditional financial institutions think of that. As Bitcoiners, we think of counterparty risk very differently, right? We think about, you got, not your keys, not your Bitcoin. That's not how traditional financial institution thinks of counterparty risk. And so beyond just having the wrapper of bankruptcy remote SPV, also having the risk transfer in the capital structure. So being able to tranche up the risk so that there's a senior tranche that appeals to somebody who wants an instrument that's over collateralized. They're willing to give up upside in order to achieve that risk mitigation. And then on the other end of the spectrum, the junior tranche that essentially wants to go leverage long Bitcoin while still having yield visibility, so that they have a percentage number to it, but that in terms of participation in the profit share, if Bitcoin really hits a home run, that they are strongly participating in the upside. And so then in the middle, the mezzanine, which is really, okay, for the credit fund that they're constructive on Bitcoin. They might not necessarily buy the moon math of Bitcoin going to $1 million, but they think that Bitcoin's going to continue to perform pretty well. That way, we're opening up Bitcoin's risk return profile to a wider set of investors that has not had access because, frankly, of the regulatory roadblock of the SEC, just not wanting to approve this for even a spot ETF, which should be uncontroversial. But now I think the new SEC is merit neutral. They're not going to prejudge any of the securities as long as everything's disclosed on the up and up. That they're going to approve more innovation.
That's really helpful to understand, and think that's a smart way to go about it. So multiple different cohorts can get different types of exposure. I guess if you're comfortable sharing, would love to hear a little bit about how you think collateralization, as well as kind of terms and the timing of these loans and vehicle.
That all goes into areas where there's a fine line from a regulatory perspective of what I can talk about and what I can't. I think that in terms of over collateralization, it really is about making sure that when we look at Bitcoin's price history, the worst performing, and I like the number of 5 years just because that gets you through the traditional Bitcoin cycle. The worst performing 5 years was December of 2017 to December of 2022, where you round trip to, let's say, 20 grand, because that was the top of the cycle to the bottom of the next cycle, with Sam Bankman-Fried and all of his shenanigans. And so if you look at that worst period, you could say Well, as long as you're decently over collateralized on the senior, the principal and interest in that scenario would have been paid on the senior, and that the junior tranche would have gotten wiped out because they would have contributed to up the stack interest on the senior and the mezz. And the mezz would likely have taken a haircut on the interest, but they would have gotten their principal back. And so that, I think, when we're thinking about putting ourselves in the shoes of a bondholder that is looking for something that is mimicking or close to investment grade, that's what they want to see, is that it now in between, right? That's where, when we look at during the life of the vehicle, that's where you want to make sure that there's no liquidation, because ultimately, if you underwrite something at the top of the cycle and it grinds down for 2 years before recovering for 3 years, if you sell at the bottom, you realize losses. But if you don't sell and you have a recovery rate and you have a constructive view on that recovery rate, then you can hold through the cycle and ultimately, create value for the whole capital stack. And so I think that's where it's important to have a vehicle that is not liquidating at the bottom of the bear market, but has a longer term view that Bitcoin's going to continue to be around. Every 10 minutes, a new block gets added to the chain, and so there's not really a real physical impairment of the network itself. It's just that there's a cyclical adoption phase for Bitcoin.
Gotcha. Yeah, that makes a ton of sense. I think maybe one question, just in terms of how you think about demand for these products and these structures and the pools of capital that you expect to come into this, because on one hand, I think part of my mind goes to, well, someone who's looking for sort of downside mitigated, a little lower upside exposure to Bitcoin doesn't really fully understand Bitcoin. Otherwise, maybe they would just outright buy Bitcoin. But obviously, there's cohorts and swaths of the investment world that have a specific mandate and they need to be investing in credit or bond instruments. So could you speak to that a little bit and how you sort of would handicap the sort of landscape of demand for products like this? And, would you agree with like that notion that, at least some portion of that, if they don't have a specific mandate, will just wake up one day and be like, well, why would I want capped upside? I'll just own the thing outright.
Yeah, and so they now have access to the BlackRock ETF, and that's a great product for them. I think that in the institutional context, a lot of investment decisions are not made by one individual. They're made by a committee. Mm-hmm. And to get consensus on the committee, you sometimes have to negotiate. And so that's where, you might want to have a product that does cap the upside in order to have the over collateralization and to protect the downside, in order to get it through a committee where you might have a lot of different views on Bitcoin. And so I think that that's where, having the right product for the right audience matters a lot. So that I think is the short answer. The longer answer, or maybe it's not that much longer, but in practice it will be longer. It's the education, right? I love doing Bitcoin education, and so this provides a product where for these institutional investors, they might not necessarily be interested in Bitcoin education if there is not a product behind it, and so getting the foot in the door is important there. And if at the end of the conversation they're like, "Hey, Pierre, we're happy about what you're doing. We like Bitcoin, but we're going to buy a spot ETF." I'm really happy about that outcome, even if it's not my product or what I'm talking about. At the end of the day, I think we're all on the same team. And so that's the same way I see what Saylor's doing with strategy and what Jack Mallers is doing with 21. That it's all about driving Bitcoin adoption in general.
Yeah, 100%. I'm glad you said that because, I think it's easy for folks to get wrapped up in a line of thinking that I personally struggle with this line of thinking, but like that somehow any of this adoption from the corporate and sovereign level is somehow a bad thing. Like you do see these takes on Bitcoin Twitter though, where it's like, oh, like, you know, the institutions are co-opting Bitcoin. And it's just like, well, you know, if you step back, like, well, how did you think this was going to happen? If Bitcoin is to become global money, obviously institutions, nation states, corporates are going to get involved. And so like, this is, I think, how, in my mind, how it was always going to play out. How do you have any thoughts there, just in terms of like, you know,
Yeah.
should there be any concern about any of this? I personally don't think so. I think everything is good for Bitcoin adoption. To your point, the education, I think, is a massive factor here of like, okay, SoftBank is getting into Bitcoin. That is a massive signal for institutions, high net worth folks all over the world to start learning about Bitcoin.
Yes. So two thoughts on that. One is that over the past 12 years, I've developed a tremendous amount of conviction on Bitcoin's decentralization. And so whether it's large Bitcoin miners like Riot or large custodians like Coinbase, I think Bitcoin is anti-fragile. We saw it with the failure of Mt. Gox in the early days. Like that did not destroy Bitcoin. The failure of FTX did not destroy Bitcoin. So I think that I have no concerns on the Bitcoin side of things. My concern is really, you know, for example, the teachers that have been saving up through their pension fund and they are relying on that to retire, and that if that pension fund is underperforming or you know, just doesn't have enough Bitcoin exposure, that it undermines their purchasing power in retirement. Do we, as Bitcoiners, do we want to say, oh, I told you so, you should have been buying spot Bitcoin and putting it on your hardware wallet and running your own Bitcoin node, and, you know, too bad for you that you put your money in this pension fund, haha, right? Like that to me is not a great outcome. It's also, I think it's an immoral outcome. Like that, we don't want to have a society where the teacher or whoever is the end recipient of, because again, these financial institutions, they're aggregating capital from normal people, right? And so through the division of labor, that's the position that they are in, and they have a mandate to help normal people, whether it's an insurance company that's going to you know, pay out claims, or it's a pension fund or an endowment or any other kind, where they're on a mission, and that I really see Bitcoin as a way to help them accomplish their mission, and that to deliver the results for their constituents. So I think that it's crucial to have them have a financial exposure to Bitcoin, because I think Bitcoin's going to be the best performing asset for the next 10 years, right? Just as it has been for the past 10 years. And finding a way to build a bridge to them so that they are actually benefiting from Bitcoin in the same way that all of us sovereign individuals are.
Very well said. Yeah, there's a lot to be said about the timing of this company launch too. I know the regulatory front is definitely shifted from where it has been, but I guess like there's a lot of shifting perception of Bitcoin as well. I guess, do you have anything you would like to share with the timing of the launch of this company? It's obviously something that you've been thinking about for a long time.
Yeah, so you know, the SEC having its hand forced last year and approving ETFs, I think that certainly shifted the acceptance of Bitcoin as an asset in traditional finance. And so now we have Larry Fink on national television saying things that are unimaginable, you know, 10 years ago of Bitcoin sits above governments. You know, can you imagine the CEO of BlackRock saying that? It's just, and then having the president of the United States say, "Oh, Bitcoin is a strategic asset." You know, this is the kind of, for better or for worse, the kind of social acceptance that is necessary in institutional finance to make progress for Bitcoin as an asset. And so I think the timing is perfect in that regard as well. And at the same time, though, there's lots of work to be done, right? So I don't think that it's an immediate overnight success. I think that there's lots of education that needs to happen to to further Bitcoin's acceptance, because that's also why there's so much upside for Bitcoin. That all of these institutions have a 0% allocation to anything Bitcoin related, and that it's only going to go up from here.
Yeah, and that's exactly right. That is the opportunity. That's the asymmetric information based on publicly available information that people are just still very slowly waking up to. I think one of the more interesting things, really over just the past couple months or so, I would say, is people like to talk about this divergence, the decoupling from risk assets. I don't put a lot of stock in any short window of data, but I'm curious your thoughts on that dynamic, because once I started really understanding Bitcoin, and I think this is true of most people, but like once you really get there, you start to view it as the most possible risk off thing you could own. And the reality is that most people in traditional finance and most normal people haven't done that level of work, so they lump it in with tech stocks, the Nasdaq. And for the past probably 2 to 4 years, there have been short-term correlations with the Nasdaq, and it sort of trades as such. I think we're starting to see little blips of that changing, and part of that, in my mind, is literally due to what you referenced around like the president of the United States calling it a strategic asset, various corporates adopting it as a store of value, not as an emergent tech play. Like that's not why they're buying Bitcoin. They're buying it to store value into the future and propagate that forward with various risks mitigated relative to other assets they could do that with. So I do think we're sort of obviously still in the early stages, but I'm seeing small little signs of people starting to perceive Bitcoin for its true nature, its true underlying monetary properties that make it risk off, in my mind. Would you agree with that? And what do you think the next potential catalysts are to continue that sort of transformation in the perception of what Bitcoin really is?
Yeah, so I think that the correlations are, as you pointed out, they change so much over time. So if we look at the Bitcoin cycles, arguably in the past, they've been triggered by the halvings. You cut the supply coming onto the market in half, and then it just causes a bull market. And that's unrelated to anything happening outside of Bitcoin. It's this endogenous shock. And now we could argue that because more than 90% of the Bitcoin supply is already mined, that the halvings are going to have a smaller and smaller effect. Maybe the previous one just, had a de minimis effect compared to the exogenous shock of President Trump getting elected and the ETFs getting approved, and that those were really the catalysts for going from 20 grand to 100 grand, right? So then going forward, what other catalysts will there be, beyond just incremental adoption? I don't know. I think we'll be surprised just by the nature of that. One macro argument would be that the other big variable is US dollar monetary policy and fiscal policy, for that matter. And so if US monetary policy loosens from where it currently is, that would be a huge tailwind for Bitcoin and for other risk on assets. But as you pointed out, that and this is something that BlackRock themselves also pointed out, was Bitcoin is not neatly in either bucket of risk on or risk off. And so, but I do think that it could enter a period of correlation with risk on if you're loosening monetary policy.
Right.
And vice versa, right? So if we have a financial crisis, and hopefully that doesn't materialize, but if that were to happen, like we saw March 12th of 2020 with the COVID crisis, like everything gets whacked. And so that's because Bitcoin, it's an asset that, if you're trying to meet a margin call on your portfolio, you just have to sell anything and everything. And so you would see a sell-off in Bitcoin in a crisis moment. But that in response to that crisis, what would happen? What would happen is that we would need to print lots more dollars. And so then you go back into, okay, who benefits disproportionately? I think Bitcoin benefits more than NVIDIA in that scenario of a monetary loosening. And so that's where, the correlation, it can still be directionally the same, but in terms of magnitude, I think Bitcoin will outperform.
Agreed. The one thing that I would maybe take the other side of is the having less of an effect moving forward, because I would argue that I expect Bitcoin's market cap to more than double each halving, somewhat offsetting at least the dollar amount of Bitcoin supply issuance moving forward. But that's my take.
It's it was nice that so I would argue that it was nice that in the past the halvings caused a parabolic bull market. But the not so nice part was then the bear market, which actually kind of prevented adoption, right? Nobody wants to buy into something that's going down. So a large part of, from a factor perspective, Bitcoin's very strong on momentum to the upside and the downside. If we have less of a halving impact, and that Bitcoin can kind of drift upwards and have, a run up and then go sideways, and then another run up and go sideways over a much longer time period, then that I think has its advantages as well, right? Rather than the manic and panic.
Yeah, no, that's a great point, because there's obviously just a, what I would call like a fear factor of people who, again, don't fully understand what they're looking at, but they see it so volatile. They also probably don't understand that, Bitcoin's volatility is unique relative to other assets, and that it's positively skewed, whereas most other assets have a negative skew in terms of their volatility. But that's in the weeds, and most people looking at it just see it going down 70, 80%, and they're like, no way. So I agree with you. Like there could be benefits to, volatility sort of dampening over time, and a slower grind upward would just be less scary for folks, and maybe incentivize them to learn about it faster than they otherwise would. So yeah, I think that's a great point. I wanted to pull up on the screen here just hash rate, just ripping. I guess it adjusted a little bit recently, but given your expertise in the mining space of the Bitcoin world, I'm curious what your thoughts are on just what we've seen in terms of hash rate, really since this dip in 21, the China mining ban. Ever since then, it's kind of just been up and to the right. And is this nation states getting into the game in your view? I think there's long been rumors of that being the case, but any thoughts in general on the mining space and hash rate?
So one factor is just the generational change in ASICs, and so as ASICs become more efficient, you can hold everything else constant, hash rate increases. The other is that Bitcoin mining is the most competitive industry in the world, right? It's entirely permissionless, and all you need is access to electricity. And there's a thriving secondary market of ASIC mining rigs, and lots of service providers, finding lots of nooks and crannies to hook into to be mining at economics that, can be almost like free electricity, right? If you've got a hydro dam that is underutilized, that you're able to hook into, or flared natural gas that nobody else is using, that you got free fuel there. So that's for one. The other part of it too is that the global competition of it makes it such that if Russia, for example, and I'm no fan of Russia, obviously, I'll start with that, but that because they have been cut off from a lot of the international financial system, one of their incentives is to access hard currency like Bitcoin by monetizing their energy assets. And so, there's that part. And then here in the U.S., the Bitcoin mining companies being publicly traded, they've had access to a lot of capital and have been able to put that to use in turning on mining rigs. And so right now, if you look at the mining economics on a dollars per megawatt perspective, it is cutthroat. And so that, I think, reflects the fact that it's just this global commodity that there's so much competition in. And now we're seeing a lot of Bitcoin mining companies start to look at, okay, how do we redeploy capacity towards AI and HPC that can have higher margins than Bitcoin mining itself at this point in time?
Yeah, that's fascinating. Maybe I wanted to, just give you a kudos for the new podcast that you started, which I think is fantastic. It's you want to talk a little bit about that, sort of just back on the angle of why education is so important and what you guys are trying to do with the new pod?
Yeah, absolutely. So Michael Goldstein and I, we met in college. He started a Austrian economics reading circle, the Mises Circle. And I was attracted to it because I had gotten into Austrian economics through the Mises Institute, which is an academic think tank, essentially, of researchers in Austrian economics based in Auburn, Alabama, that had been publishing on the internet. And when I was in high school, I was downloading MP3s onto my iPod to just kind of give you an idea into how early I was into the podcast game. So when we were learning about Bitcoin, the information was in lots of different places. And so we wanted to, and Michael especially, he's the, I would really say he's the founder. He's the president of the Mises Institute, of the Nakamoto Institute, Satoshi Nakamoto Institute, to pay it forward and to get all these resources into one place, translate them into lots of different languages, and to help drive forward Bitcoin adoption. Because ultimately, yes, Bitcoin is software, it's code, but it's also, I think, an ideology, an ethos around it, a culture that is, if we want people to understand what Bitcoin's value proposition is and why we shouldn't, go and change Bitcoin or start another cryptocurrency and all of these big questions, kind of be putting out thought leadership on that. And so the Nakamoto Institute has been, I think, the best avenue for looking at even pre-Bitcoin thought. There's lots of cypherpunk writings that Satoshi Nakamoto drew from, all of Satoshi's writings, and then kind of the post-Bitcoin thought of, okay, Bitcoin exists, let's try to wrap our heads around it and try to explain it in different ways that might be, relatable to folks. And so, and be timeless, right? So it's not like, it's not about current events. It's really about trying to figure out what are the timeless aspects of Bitcoin. With the benefit of hindsight, we wanted to go and look at what had been written 10 years ago and take a fresh look at it. And so that's what we've been doing on the podcast, the reorg, which is a technical term from Bitcoin, that Michael and I have been recording. I think we got 10 episodes now under our belt. We recorded 2 more today. So,
there you go.
Just to keep it fresh, and also to for people who are not around 10 years ago to resurface these articles and to look at it with our 2025 eyes.
Yeah, I've been listening to all of them, and they're great. I would highly recommend to anybody.
We'll throw it in the show notes. It's fantastic stuff.
Please check it out. And there are a lot of great writings in there too, and really appreciate your perspective on old ideas with a little bit of a fresh look too, and many of them are very timeless, as you mentioned. So if you have a question or thought or concern, it's probably answered within the reorg or somewhere on the website.
Yeah, well, thank you, Liam. And we're standing on the shoulders of giants, because obviously, if I were to say like everything on the Nakamoto Institute was already discussed in the Bitcoin Talk forums in 2011, right? There's a lot of history there. It's been a lot of fun to put together those resources.
Yeah, it's truly fantastic. And Pierre, I will say I'm jealous that you started learning about Austrian economics in high school. My high school teachers and even my college professors, I majored in economics, didn't learn one lick about Austrian economics. So that tells you everything you need to know about the institutionalization of Keynesianism over the years. Maybe one question, because we're coming up on time and want to be respectful of your time. But maybe just sort of going forward, what can people expect in terms of quasi roadmap, if you will, for the Bitcoin Bond Company, and where can people learn more about it?
So it's a ton of work behind the scenes, and just follow me at Bitcoin Pierre on X as I have updates. That's where they will go. This is not it's not a retail facing product, and so in many ways it's just me out here in the trenches. I hope to have more over the coming, let's say, years.
Awesome. Well, thank you very much for joining us. This is a great conversation, and always appreciate your insights and thoughts, Pierre. So thanks again for joining us.
Yeah, thanks, Brian. Thanks, Liam.
Thanks, Pierre.
All right. Take care, boys. Thanks for listening to this week's episode of the show. If you found the information valuable, please share the episode with a friend or leave a rating on your favorite podcast app. All the links we discussed in today's show will be in the show notes inside your podcast app. Before we finish, a quick reminder that Onramp Media is for informational and entertainment purposes only, and nothing should be construed as investment or legal advice. Regardless of where you are on your Bitcoin journey, we'd love to hear from you. Visit onrampbitcoin.com/contact to schedule a consultation with one of our private client advisors.